Hi guys, I'm Karunya Rao, and in Ideas for Profit, the spotlight is on Dhanuka Agritech. Deficient monsoon in August has weighed on the near-term growth prospects for domestic-oriented agrochemical companies. Deficient rainfall has impacted the Kharif crop sowing area. In fact, according to the Department of Agriculture, overall Kharif sowing till start of September stood at 1,081 lakh hectares, which is marginally lower than 1,094 lakh hectares in the corresponding period last year. Dhanuka particularly has been impacted, because of which its growth guidance has been revised downward. Weak rainfall has added to the other prevailing headwind of a spike in raw material costs. Now, the stock has remarkably underperformed, which led us to take a closer look at the investment case given the company's plans for backward integration and export opportunities. With slightly lower than normal and delayed rainfall in June and July, the management lowered its full year guidance in Q1 earnings call. With the rainfall turning deficient in the month of August, the company expects flattish revenue for Q2 FY22. For the overall FY22, the management has downgraded the growth expectations to single digits. September rainfall will be a key monitorable to watch. Reservoir levels, meanwhile, at 111.7 billion cubic meters are lower as compared to last year, but are closer to the average of last 10 years, which is 119 billion cubic meters. The pickup in rain in September, coupled with healthy reservoir levels, bode well for the upcoming Rabi crop, which would lead to recovery in the second half of FY22. Raw material prices have been on an uptrend owing to increase in crude oil prices, impact on the supply chain because of COVID-19, increase in container rates because of the shortage. Besides, the firm global demand owing to rise in commodity prices has also led to a rise in raw material costs. Now, demand in the domestic market is likely to be affected by deficient monsoon. In a subdued demand scenario, there's a need to clear inventory, which could lead to pricing pressure. Dhanuka, of course, would not be able to fully pass on the price increase to consumer, which would affect the company's margins. The management has guided 200 to 150 basis points impact on the margins in the current fiscal year compared to FY21. Dhanuka's Innovation Turnover Index (ITI) has been on a decline for the last 2 to 3 years. The share of new molecules in the overall revenue pie declined from 17% in FY19 to 11% in FY21. Restriction on field activity because of the ongoing pandemic has dampened volumes for new launches, but with the pandemic receding, the company will resume field activity and demonstrate benefits of new products on field to its customers, essentially farmers. Dhanuka recently launched Torando to control broadleaf and narrowleaf in soybean crop. It's received registration on new herbicide 1Kill for controlling weeds in onion crops. Dhanuka will be aggressive on new launches going forward. It aims to launch 8 new products across herbicides, fungicides and insecticide segments over the next 2 years. It expects the ITI index to recover from FY23 onward. Dhanuka has started construction of the Dahej plant. There were some delays in the construction owing to COVID second wave, but the company expects to complete the work by March 2023 as guided earlier. Phase 1 of the plant would be completed by end of this fiscal. In fact, the company is planning to invest a total of 300 crores in this plant. The company will undertake technical manufacturing of pesticides, which is a backward integration step for the company. According to the management, about half the production will be towards captive consumption, which would reduce raw material costs. The management expects a benefit of 50 to 55 basis points on the margins on account of captive sourcing. This will also reduce dependence on raw material imports, which currently contribute about 25% of overall consumption. The remaining half of the production would be sold in the open market. Do remember that Dhanuka is also in talks with Japanese and other innovators for exports of intermediates or CSM exports from the plant, which can open export opportunities for the company. With concerns of deficient rainfall and its impact on growth, Dhanuka's stock has corrected by about 13% in the last 3 months against benchmark Nifty's gain of 10%. This stock has adequately factored in all the near-term growth concerns. Now, we expect resumption of double-digit growth for the company in FY23, mainly driven by new launches. Also, the commencement of the Dahej plant will lower raw material costs and export avenues will be opened up. Dhanuka has a strong balance sheet with zero net debt and robust return ratios. We continue to be optimistic on the long-term growth prospects of the company. At the current market price, the stock is trading at 17x FY23 estimated earnings, which is close to its long-term historical averages. We recommend investors to add the stock on weakness.